I started this YouTube channel over 3 years ago with the idea that I would bring my financial knowledge. I'm a CFP, a CHFC, and a CLU to the public and see if I couldn't help you make better investment decisions. Well, it's grown into something much bigger than what I thought it was. It's not about financial planning. It's about figuring out what's happening in the stock market and how I can react to it, how you can react to it, and we can make some money off it. We've now entered into a point where things have gotten really screwed up, and our banking system is in trouble. I just read an article today where people who have annuities are in trouble, and I think it's time to step back and say, okay, what's going on and what should I do today? I've been a very strong proponent of investing into the future, that general technology and genome sequencing and artificial intelligence is going to take us into a better world. But in the background, the world's gotten kind of screwed up with the banking system and the manipulation of money and quantitative easing. And we need to make sense of it and say, okay, is it time to step to the sideline? And if we step to the sideline, where did we go? That's not my forte. So with that in mind, I've called my investment committee together, and that's made up of Mark and Trent and Drew, and said, okay, you have different knowledge than I do. Where do we go today? And that's what I want to do. And I hope this becomes a Monday morning regular feature on this channel so that we put multiple minds together. I hold a meeting of 20, 30 people on Friday where I gather information. And now we're going to do this on a Sunday. So this is what I've put together. This is not financial advice. This is financial education of me, you, and my tribe, and hopefully you'll become part of our group as well.
Best of Us Investors presents Carrie Griegmeier.
Let's start from the big picture and understand why the ideas that we'll share at the end of this. And Mark and I look at this, and correct me if I'm wrong, Mark, from a bigger picture, macro perspective. Like, why is right now the foundation of our financial system under question? And since 2008, Ben Bernanke implemented what was called quantitative easing, not just in a sense of we're going to bail out the banks as they did, but more of a use of using it as a form of stimulation to a slow-growing economy. Well, in 2010, we were in a slow-growing economy, and Ben Bernanke felt, I'll use quantitative easing, which is the act of putting money into the economic system via the Federal Reserve. And the Federal Reserve gives that money out to 12 different prime dealers. Prime dealers, then, those are like the Chase, JP Morgan Chase, the Goldman Sachses, the big banks that Bank of America that we all know. They then take that money and they, in a sense, duplicate it and lend it out to you and I, the individual consumer. We go borrow money to buy commercial real estate. We borrow money to grow our factories, our small businesses. We even take that money for individual needs such as credit cards, along with residential. And from 2010, really up to 2020, we saw an expansion of more money in the system, which meant that the Federal Reserve printed more money, in a sense, and distributed that money. And in exchange for cash from the Federal Reserve, the prime dealers would give them treasuries. Well, in the past, they opened up their window to many different types of debt, such as mortgage-backed securities, credit card loan type bonds, car bonds. What's that? Corporate. And they opened up their whole window, and their balance sheet, the Federal Reserve's balance sheet, expanded from 800 billion, I think, at some point in 2008 to 4 trillion. Okay, so they took on the debt. In exchange, they gave the prime dealers dollars, and then they went out and replicated that to the consumer. And the consumer used it, grew their wealth through investing in the stock market. They bought stuff, and that's how our economy works. We buy things and sell things, and our economy grows, our GDP grows. Well, fast forward. Yeah,
I
go ahead,
interject a little more?
please. Absolutely.
Also, on the other side, you had corporations and companies borrowing cheaply, just about at zero. And some are very profitable companies like Apple or Microsoft, and they would take that money and either reinvest or buy back their stock. Now, other companies like we saw during the pandemic, the growth companies with no earnings, they borrowed at zero interest now too, and now they have no earnings whatsoever coming in, and now the price of of borrowing is higher, and the scarcity of cash is there, so they're going to see a lot of trouble too, in my opinion.
Yeah. And so
Right.
we get to COVID, the world shuts down. Liquidity dries up. It's like the oil in your engine all of a sudden is gone and your car engine seizes up. So what they did was they went out and just injected an enormous amount more in quantitative easing and took their balance sheet from 4 trillion to over $9 trillion. And we had the best 3 years, 74% increase in residential real estate in 3 years. That's insane. The value of your home went up, that of homes throughout the United States went up that much. And it's because of liquidity. We get to January.
Now, here you say with liquidity,
Yeah.
because there was so much money in the system.
Yeah.
Okay.
You could
now we have an abundance of money. Some of that money went to Tesla, to Kathy Woods, to Bitcoin, and people took on tremendous amounts of debt.
Right. It was cheap.
Okay.
Yeah.
So they multiplied the 9 trillion or whatever that came into the market through debt. All right.
Yeah. So January of 2022 rolls around, and there's hints at they're going to start raising the Fed funds rate, which is the interest rate that the Fed lends that money to the prime dealers or prime banks. It was at 0.25%. Okay, that's nothing. It's basically, if you factor in a couple other things, it's at actually a negative number.
Right.
Okay, so from March of 2022 to today or last Wednesday, they raised the Fed funds rate, the cost of borrowing money from the Fed, 9 times. 9 times. So they went from 0.25% to today 4.8%. Okay, that is an enormous jump.
Yeah.
The
Quite
cost
a multiple.
the cost on that now, if you're a business, you typically borrow money based on prime, the prime rate plus. Okay, if it's a mortgage, it's prime plus 3.
Mhm.
That's what your bank is lending to. So you went from prime in January of say 2022 at prime at 0.25% plus 3 on a mortgage, which would have been 3 1/4. If your credit's bad, it's a little bit more, right? To today, prime at 4.8 plus 3, you're now borrowing at 7.8%. With a residential mortgage, it's locked in typically, unless you have a floating rate or something like that. But with corporations, their rates change based on mark to market, meaning whatever the market prime rate plus is at that given, if they reevaluate on a monthly basis or a quarterly basis, that cost of that loan has escalated drastically, which then leaves a lot of companies, because as the economy started to slow, as we have seen slowly, the economy slows, less revenue comes into the business, less revenue comes into the household, yet my cost to service the debt increases. So you have this thing, this teeter-totter effect. You
Not
bring
to
that,
mention inflation.
mention inflation, absolutely. There are
And
two
also this is affecting, I'm sorry to interrupt, but
No, please do.
I'm on
Yeah.
your side, and the cost of the national debt is
Oh
going
my
up
God,
because
yes.
we finance the national debt through short-term treasuries. And I know by purchasing treasuries, that short-term treasuries, that what they're paying me as an investor is a lot higher than it was a year ago.
Yeah. Yeah.
And this is, as I understand it, this is what brought down Silicon Valley Bank and the other banks, that Mark saw that he wasn't getting but 2% on his savings in the bank, went to Silicon Valley Bank, said, take it out. I'm going to put it into a T-bill or a treasury where I can get 4%. And so their liquidity evaporated.
Yeah.
Okay. I understand all that.
I think it's important to understand.
When are we going to get to what I should do about it?
In just a second, you have to understand how a bank works. It's very important. A bank has inflows through deposits. They take those deposits and they do 2 things with it. One, they lend that deposit out and they charge an interest rate to other participants in the bank, other clients of the bank. 2, they invested in 3 different types of asset holdings. They have a traded account, which means they trade that on a daily basis. Number 2, they have hold to maturity account, which means I buy a bond, I hold it to maturity, I reap the yield, plus I get my par value back at the end, which is what par value is, what they issue the bond at, the value, and what you receive back. Okay. And then they have everything else. Well, in 2000, because of the financial crisis, they changed the rules on what banks could hold. And they can hold mortgage-backed securities, and they can hold US treasuries. Okay. So they get your deposits over the last, say, 12, 13 years. And they're doing this with, they're lending money out, they're making money that way. You're depositing money via your paycheck every month. And then they take that and they invest that money. Well, when back 10 years ago, 5 years ago, the US, a 2-year treasury bond was paying out on yields less than 2% easy, right? Okay. Fast forward to the Silicon Valley Bank issue. What has happened is they put all this money into these hold to maturity assets. They can't go anywhere else with that money other than mortgage-backed securities and US treasuries. And the value of those bonds, think of bonds as a teeter-totter. It's you on the left side and your buddy on the right side. You represent yield and your buddy represents the value of that bond. Well, yields went up because interest rates, federal funds rates, went up and driving the value of that bond down. Well,
the old bond, the prior issued bond.
Correct. And so they have all these bonds and all their assets in this asset that's losing value rapidly. So all of a sudden, you have this scenario where their overall balance sheet is underwater. Here comes Peter Thiel and says, I'm really nervous about my money at Silicon Valley Bank. And he's public about it. And he starts withdrawing money. And all of his private equity friends start doing the same. So all of a sudden, they just lost. Silicon Valley has just lost their one income source. And it's gigantic. And they don't do a lot of loans. Okay, like a traditional bank, say a Bank of America or a Regions Bank, a local bank. So they don't have a diversified income source. And all of a sudden, the headlines get it, and they just have a bank rush, and they crater the bank, along with Signature Bank, Silvergate. And now everybody's questioning, what is the stability of our banking system? And last week, over the last 2 weeks, we've seen over $100 billion reduction in deposits, meaning people taking their paycheck or their big income from their businesses and putting in their bank. And where are they going with it instead of the bank? Mark, you have been a master at this. And even Drew has actually learned from Mark where he's putting his deposits instead of the bank. He's putting them where?
I just had a question. So before Mark goes on, so I do see a lot of people, with the bank, the Silicon Valley Bank and the Signature Bank, this happening. A lot of people around me, ask, where should I put my money in? And in my generation, a lot of people are saying that they are actually taking money out from the regional banks and putting them into either, Chase, Bank of America, or the safe, like 1, 2, 3 banks. So another issue is, the regional banks are in big trouble, right? And it's heating up because people are taking their money in the regional bank and putting them into the major banks. That's another way that they're getting deposits out. And a lot of people in my age or younger generation is now, they're saying, look, the financial system is crushed. It's corrupted. You should go into crypto, Bitcoin, or, and that's why some money, in my generation, they're actually putting some money into crypto as well. And I think that's why Bitcoin and the cryptocurrency are like stocks, were actually going up. So that's kind of what I'm seeing.
Yeah, and I think Mark, you were about to share with us what you've been.
Well, let's address this because I think this is really important. Is that a safe move? Is it a safe move to go buy Bitcoin? Bitcoin was at 60, it went to 16, it's now at about 24. It's been a hell of a good performing asset if you got into it down at 16. So is that a safe place to be?
I think number one question is, what is the accessibility on a global scale to Bitcoin in particular? Roughly, if my numbers are right, it's less than 5% of the world population owns Bitcoin. In comparison to US T-bills or treasury bill bonds, Bitcoin doesn't exist in comparison. And so
my input on it is one of the reasons this is all happening within the banking system is the lack of regulation and the lack of enforcement of existing regulations. So if I take that same equation and apply it to Bitcoin, there is no regulation.
Right.
So it is a big flashing sign, danger, be careful, that we don't know what this is. So if we're talking risk and reward, your regional bank's probably safer because the government already has said, we'll guarantee 250, and now they're upping it to 500,000. No one has came forward and said, we will guarantee 250 or 500,000 on Bitcoin. So if you're risk adverse, you're walking into the swamp.
I think it's a generational thing too.
Well, I'll agree with that.
Okay.
Well,
So,
in Bitcoin, I'm not an expert on Bitcoin in any way. Drew probably has more knowledge than all three of us combined, but I know that Bitcoin doesn't have a CEO. Bitcoin runs on its own, and it's out you can see every transaction that's out there. There's only 21 million Bitcoin available. It's logged and registered. I think the only way that I don't think it's ever been hacked, has it, Drew? And no. I think that it's all out there to see on the blockchain. and you can lose Bitcoin by losing your passkey. But I don't think it's ever been hacked away out of the system, other than when you take it off and you die and don't give someone your passkey or whatever. So it's hard to go after Bitcoin or regulate Bitcoin because it's not a corporation. It doesn't have a CEO. Okay, it exists in its own blockchain world, which banks use blockchain all the time. So, am I right or am I wrong on that, Drew? From kind of the way I look at Bitcoin.
So as far as I know, Bitcoin has not been hacked. The exchanges has been hacked. That's been an issue, right? So a lot of people are losing money. What I'm saying here is I'm not, I've been investing in Bitcoin since 2017 and I'm not touching that. I'm not investing anymore. I think it's risky. And I do agree that you can lose everything if you lose your private key. You don't know what's going to happen. But if you look from 2008, there is a 4-year cycle after the Bitcoin halving. And it's surprisingly accurate if you look at the charts. And this is just something, out of the topic, but if you look at that cycle, 2023 is the period where people accumulate. That was like the early 2023, like when it was in, I think 15,000 or something. And then it goes up like crazy, right? This has happened 3-4 times already. So there's a cycle. I'm not sure if it will happen again, but it does happen surprisingly accurately with after the Bitcoin halving, I think, which will happen in 2024, something like that. So that's something I'm just watching. The other thing that I wanted to point out was that I think the regional banks are in risk, but a lot of money is flowing into the major banks. But if you look at JP Morgan and Schwab, the stocks are going down like crazy. So I'm just wondering if these major banks, if they go under, that's a huge issue, like not just for the banks, but for the whole economy. And I was just wondering if you think these major banks, not the regional, if these banks have a percentage of have a possibility of going down, or is it a good opportunity? I'm just curious to hear about your thoughts on that happening in the market.
So over the last 2 weeks, the Federal Reserve has what they've called quantitative, or their balance sheet. And on March 8th, their balance sheet was $8.34 trillion. Since March 8th to the 22nd of March, that balance sheet has gone from 8.3 trillion to 8.7 trillion, a $391 billion increase. Why is it increased? Because the Fed opened up what they call their discount window, where banks, they changed their laws on March 15th. The board decided to change their laws to say that the banks could come in and borrow money from the Federal Reserve discount window, and they had a 90-day hold period on it. If they felt that, it actually reads this way: narrowing the spread of primary credit rate relative to the general level of overnight interest rates to help encourage more active use of the window by depository institutions to meet unexpected funding needs. Okay. Basically, the Fed said, oh no, we did it again. These banks are becoming insolvent, and there are a handful out there that are insolvent. We need to put oil in the engine, into a cylinder. The banks representing a cylinder. They opened their window up and they said, come get it. Come get it. And the banks rushed in at a $391 billion rate in 2 weeks.
So this was to basically make sure they're solvent if someone comes and wants to withdraw.
Yes.
So again, the government has made that secure.
Yes.
I interpret that as a good thing.
I interpret
from the
it
point of view of security of capital. I interpret it as a bad thing, is we're just flushing more and more money into the system, that it has no real, it's decreasing the value of the dollar that you had in your pocket before they opened the window.
Right. One other thing, since 1st of March to close of business on Friday, we've seen the 10-year treasury yield. Remember, yields go up, values go down.
Right.
Go from 4.12% yield to, I believe, down in the 3.8 range. Meaning,
now, why is that?
Institutions, smart money, banked, need pristine capital. Pristine meaning, think of a diamond. It is pristine. It's shiny. It's beautiful. It's exchangeable anywhere in the world. Anybody who sees a diamond's like, that's worth a lot, right? AAA rated, if you think of it. Institutions are now, because of the lessons they learned from Bear Stearns' collapse, they are now rushing out and trying to find pristine capital, and they're willing.
I don't understand pristine capital.
Capital,
a clean dollar bill as opposed to a dirty one.
Capital that is liquid, U.S. Treasuries, liquid.
Okay.
Capital that everybody says this is perfect. I can live with this.
It's not a mortgage. It's not a mortgage. It's not a student loan.
It's a U.S.
It's pristine. Okay.
And if you look at long duration, so 5 years and beyond, the yields over the last 2 weeks have fallen. And the institutions, the banks, are all saying we're in a crisis. Couple that with the Federal Reserve's March 15th ruling on their discount window, opening that up to banks. Everybody, the smart money, is scrambling right now to put their money in assets that are liquid and that will be backed by an entity that has some level of credibility, and that's the United States.
Okay, so I think what you just led me into is where I should put my money, and that's where the smart money is putting their money.
Yes.
Okay, and
But
that
if you
brings.
look-
Let Mark jump
Go
in.
ahead.
If you look at, and I brought this up in our Platinum Channel discussion, Bank of America watches money flows pretty much. And last week, their note came out and they talked about assets under management in money market funds have now surged above 5.1 trillion, setting a new all-time high, recording inflows of more than 300 billion over the past month. In the previous 6 weeks, 29.3 billion has flowed into U.S. Treasuries, the greatest flow ever recorded. The iShares Treasury bond, which is GOBT, recorded 3.4 billion of inflows over the past month, posting the second highest monthly inflow ever. And this is what got me is the last two significant increases in money market flows accounts or assets under management were in 2008 and 2020. Both were followed by an aggressive Fed rate cut. In 2008, money market flow assets grew from 2.5 to 4 trillion, and the Fed slashed rates from 5% to 0. In 2020, money market funds assets rose from 3.5 trillion to 5 trillion, and the Fed funds rate fell from 2.5 to 0. So you're seeing, if you're a student of history, you're seeing history repeat itself. And if you go back, I go back and look at opportunity cost. And opportunity cost and lost opportunity is if I have money in the stock market during the Great Depression, okay, in 1929, and I left it sit in there, and the market fell, and it started in October of 29. The Dow fell by 11%, and then continued till 1929 when the Dow fell another 12%. So in total, the Dow fell by 89% over 3 years, and it took the market until 1954, 25 years for it to get to its pre-crash level. Now, in the panic of 1907, which interestingly enough, the Dow fell 48% over a couple of weeks, and it was due to a liquidity crisis. And who came in and saved the day was J.P. Morgan came in and saved the country in 2007. Then you have the recession, of 1937. The Dow fell by 49%, and it took 4 years to recover. Black Monday in 1977, the Dow fell 12% due to fears of recession and inflation. Okay, what's that sound like? Okay, how long did that take? 7 years to recover. So if I have my money in there and I'm going to hold, I've lost 7 years, 25 years, whatever, of opportunity cost. So when I talk on swing trading and I talk about trading and investment, money flows to where the value is. And so the institutional investors just don't sit and buy and hold. They move it to where the value is. When I look at my own personal investments on how I look at it, there are two things I always gauge it by: my risk tolerance, and I'm risk averse, and my time horizon. Your time horizon is how much time you have to invest and recover from a 7-year drought. Okay, so as you said, I'm in the latter end of the baby boomers. I don't have a 40-year runway to get my money back, or a 25-year runway to get my money back. So I watch charts and I watch when to get in and get out, and like Paul Tudor Jones did in the great financial crisis. He watched the 200-day moving average, and when the major indices crossed that, he got out, and it was great. It saved him 40% in a drop. So I did the same thing 2 years ago in January and pulled out of index funds, and I've missed basically this whole drop. And it was because I study history and I study people who are successful in those history. But at that time, there was really nowhere to put it. You're sitting in cash, so you do some swing trading and you make up some of your losses there. Well, not losses, but your gains, because you still have a 5-6% inflation rate. But now with what's going on with the Fed over the last year, now all of a sudden treasuries have become more important, and also CDs, where you can get short-term 1 month treasuries and CDs a month ago up to 5%, and you can still do that now, basically with CDs. You want to watch the banks you're getting them from, but you're doing a 30-day CD, getting 4.5% to 5%. Now that's annualized, over 12 months, but it's certainly a lot better than having your money in the market and losing for the next who knows how long, and also, losing on inflation. Now I don't know how long this market's going to be down. I don't know when it's going to spring back, but I don't have the time horizon to wait or guess with it. So I'd rather have money out in a safe investment, even though it's only making 4 to 5% on short term. I'm not doing the same thing that Silicon Valley Bank did, put them in a 20-year. I'm not doing that, and you can go get them at 3% or whatever. But
so let's move this conversation.
Let's
move this conversation from we now recognize how we got to where we are and where we might go from here to where's safe haven, and how do I have an E-Trade account. Where do I go if you can show me on Fidelity or somebody, where do I go to buy these short-term bonds that I can manage?
I can put it up, my screen up where I go, if you want to see
Okay,
it.
I'd appreciate that.
Okay, because a lot of people, they don't know where to go get CDs. They don't know where to go get Treasury. You can go to Treasury Direct with the U.S. government. You have to open an account, and every Tuesday and Thursday, Treasuries have auctions, and they have short-term auctions, I believe, on Tuesdays and the longer term on Thursdays. And then they have an auction window, so you got to get in, see what they're going to offer, and the price you might see may not be the price you get because it fluctuates over those few days that the auction's open. So let's go
at
over
Treasury Direct. I'm buying them directly from
the U.S. government.
The U.S. government. Okay.
Yep. Or you can go on,
and that's Tuesdays and Thursdays.
Tuesdays and Thursdays, you'll see them come up.
Okay.
Or you can go on to your brokerage. I think most major brokerages have a function where you can buy CDs and treasuries and agency securities and municipal bonds and those type of things. So I'm going to share my screen. You guys should be able to see it now.
Yes, we do.
Let me interrupt real quick. First of all,
Okay, go.
this is not a recommendation or advice. Number
That's
two,
right.
we're not sponsored by Fidelity. We're not
No.
receiving money from Fidelity. This just happens to be the platform for which Mark transacts his trades and holds his money.
Right.
All we're trying to do is educate you.
Correct.
Yep. And I think that everyone has, I think your E-Trade would have this too, Kerry.
Okay.
I think Charles
All right,
Schwab.
I'll find it.
Yeah. Okay. So I come in and you just go up there and you'll have your accounts and you'll have your planning advice. I just go over to products and come down to fixed income bonds and CDs. Just hit the button. And it says for investments, it'll tell you, how to do it. It's all education. And I just search for investments. And I come down and I think that I get charged a commission if I don't use new issues, but you can come down to Fidelity and it'll show you bonds, treasuries, zeros, what the rates are. You can click on those and see where the rates are, municipals, corporates, just about anything you want. I come up here and I do the new issues because these I don't get charged
Okay.
commission on, and I hit the new issues. You can see new issues here. I've got treasuries. There's 7 products available in treasuries, 110 in CDs, 2 in agencies. This is your government agencies, corporate if you want to get corporate debt, and municipal debt if you want to do municipal debt. So I hit treasuries. We come over to treasuries. Oops, sorry, wrong one. 7 are available, and these are the longer term ones. These came out Thursday, and we're talking on Sunday here.
Okay.
So here's one right here. This one expires. Maturity date is 4/17, so that's a little under a month from now, and you're getting 3.35%. Okay. Here is a treasury that expires. Okay, it's a treasury bill. Anything under a year is basically a treasury bill. This expires in 3 months. Okay, so it'll expire on June 29th of 2023. You get a 4.479 rate. If that's where it closes at, when it closes, the settlement date is March 30th, which is coming up this coming week. Okay,
So wait a second. What's the settlement date mean?
Settlement date is when the auction ends.
Okay.
Okay.
So okay. All right. Now
Yeah.
you say auction. You're saying I'm not guaranteed to get that 4.479%.
Right. There's a bunch of banks go out and bid on this, individuals bid on this, and this is how I do it. So it'll be similar or very close to that level.
If I buy that, what's my minimum purchase?
It'd be $1,000 on
Okay.
this one.
And so then you go in and say, if I got $10,000, I want 10 of those bonds,
Exactly.
treasuries. Okay. All right.
So
I'm with you.
you just come over and you hit a trade button.
And they'll let me know on the 30th what my actual rate is.
Yep. And it'll be
I
in
see.
there. And then when it matures, it'll give you back your money and interest at that time.
Okay.
So here's just a trade tick. I'm not going to go into it, but it puts
Right.
you put in quantity of 1 to 10, whatever, but each one's $1,000.
Okay.
You come over, you can have a rollover function if you want, that'll automatically roll it over if you want.
Meaning it'll buy when the bond matures, it'll buy the next
Right.
bond. Okay. Or
Okay.
next period's
Absolutely.
bond.
Yeah, so here's your expected yield, okay, on
Mhm.
a 3-month treasury,
Okay.
Now that's annualized, correct?
annualized, yep.
So you would divide that by 12, multiply
Yep.
it by 3. That would be essentially what you should be paid.
Absolutely, but it's still, it still would add up to 4.479%.
Gotcha.
Right.
Or you can
Okay.
go down, you can see we have, this is a 6-month treasury here. They're only offering 4.1%. So in my mind, I'm like, why
Yeah.
would I buy a 6-month when I can get a 3-month and get more?
Unless
So-
you anticipate that Jerome is going to lower rates and that you at 6 months you're going to have 4.1. At the end of your 3 months, your 4.7 is going to go away.
Yep.
Okay.
So there's a risk that,
Yeah,
in 3 months
yeah,
you won't
yeah,
get that same
okay.
rate.
All right.
The one thing about T-bills is they're backed by the full faith of the U.S. government. So if the government goes down, you're going to lose your money. But if the government goes down, we got bigger things to worry about.
Yes, we do.
And also, I believe that in most states, you only pay federal tax. You don't pay state or local tax on your gains on T-bills, but check with your accountant in what state you live in for
Okay.
that. So let's go back up. And what are my other alternatives? Okay, so here were treasuries. Let's go into CDs.
One more thing is, this is where I got kind of confused based on my experience. So again, I live in California, so the taxes are really beneficial to me. The other thing is for the T-bills, I noticed that if you buy it, it's not that you buy $1,000 and then you get 1,000 and something money back. It's that
Right.
when you purchase it, you buy it at a discount when you buy it.
Right.
So
Yep.
if it's 1,000, you buy it at 980 or 70, and then
Could
when
be
it
900.
matures, you get that.
Yeah. Could be
And when you-
992 or whatever. Yeah.
Yeah, and then after maturity, you get that $1,000 back, so you're making that profit guaranteed.
Okay.
Exactly.
Okay.
Yeah,
And
Glad you
that's
brought that
exactly
up.
true.
That means it's trading at a discount. Now, if it
Right.
was, now if popularity in these bonds increases drastically, you could be buying bonds at a premium, as we have seen recently with yields falling. So there's a great opportunity here because the value you're buying it at is lower than the par value, versus in some cases you may be buying it at a premium above par value and you would lose money on when it matures at $1,000. So let's say you bought it at hypothetically $1,005 and it matured at 1,000, you lost $5. And that is essentially, in a way, what we're seeing by the big institutions. They're going further out in duration beyond a year because they're willing to take the potential loss because they're fearful and they need pristine capital to make sure they can stay liquid.
Right. And that brings
Okay.
up a good point, is that treasuries will trade on a secondary market. Okay. So you can get out of a treasury, but like Trent just said, you might get out at a loss. And that's where Silicon Valley Bank and these banks are having trouble. If they get out of their treasuries, they're going to sell at a loss, basically, because they didn't wait
Okay.
until maturity.
What has to happen now that I bought a bond at $950 that matures at 1,000? How does it happen that maybe somebody comes and offers me $1,100 for it? What is the scenario there? Interest rates go
I've
down?
never sold. I've
Well,
never
if
sold
interest
mine.
rates go down, my bond becomes worth more, right? Okay.
It's what people would, if you wanted to put it on the secondary market,
Yeah.
you could sell it and make more if somebody wants to buy it at that price.
Okay. I want to wrap this up because we're beyond 30 minutes. I think this is very
You want to
valuable.
go to a CD and do that real quick?
No, I think we've given
Okay.
enough. What I want to do is we'll see what kind of reaction you, the viewers, pull on this. If you like it, we'll do it again, and we'll go deeper and we'll talk more. And what I'd like to see is this become a Monday morning regular issue. And then when we get our website, we'll probably move it all over to there. Okay. So I want to thank the three of you for taking your Sunday afternoon, and you, the viewers, be aware all four of us gave up part of our Sunday afternoon with our family to help educate you. That is what this is. I want to again emphasize what was said earlier. This is not financial advice. We are not getting paid by Fidelity or the U.S. government or anybody else. So we don't want to get involved in this other stuff that's going on. And in the comments, let us know what you think. And if you want it, we'll deliver it. Anything else anybody wants to add?
I just
Okay.
said, they can vote by hitting the like button and subscribing too.
There you go.
Yeah.
That's a fantastic idea.
There you go.
Okay.
And share it with a friend.
And share it with a friend. Yes, that's very, very good. Okay. Thank you guys for taking the time.